I'm Taresh Batra. I'm the VP of Finance and Investments here at Range.
What do you think the overall sentiment of Range clients was, or what their thoughts, questions were over the last few weeks around the election?
I think there was a high level of interest. Our members are pretty attuned to the markets. They care ultimately about the performance of the markets, and they recognize when there's geopolitical events or broad economic data points that are being released. So they're pretty informed, they're pretty aware, and I think that there was a lot of interest as to how these elections, both the presidential election and the elections in Senate and Congress, were going to impact the financial markets.
Give me your thoughts on how you think everything went down over the last week.
Yeah. The punchline is I'm not surprised. And I think it has less to do with the actual result of the election, but more just the underlying economic situation right now that we're in. I think it's been pretty well publicized that presidents don't actually control markets, right? There's a lot of data around that, which, by the way, is fantastic news for us, for all of us that are invested in the markets, right? The markets go up under Democrats, they go up under Republicans. There's market drawdowns under both parties, but 8 of the last 9 presidents have actually seen double digit returns for the markets during their tenure. So again, it's great news for us that regardless of the outcome, I think markets generally have moved up. I think the reason why the markets have been strong is really primarily due to the fact that uncertainty has gone away. I think market participants just generally don't like uncertainty, right? They don't really know the playing field. And I think that there's typically a lot of nervousness going into a presidential election. And you can see that in different data points. So you saw volatility, like the volatility index, move up going into the election. We had the markets hit an all time high in mid October, but then really the week leading up to the election, you saw a pullback. You saw a little bit of nervousness come through. Hedge funds, which deploy capital on both the long side and the short side, they actually took capital out of both of those trades, right? So they degrossed or took exposure down going into the election just because they wanted to take risk off the table. So I think I'm in the camp that no matter who would have won, probably would have been pretty positive for markets just because that uncertainty labor goes away. And I think really the reason why markets are strong is much more about the economic setup right now, as opposed to who won the presidential election. And the economic setup is really good. So this economy is a strong economy. The job market is in a good spot. People have jobs. Unemployment is still low. It's crept up a bit, but compared to historical standards, we're at very low unemployment. Consumers are spending incrementally. They're spending more. So consumer spending is moving in the right direction. GDP has been up about 3% over the last couple of quarters, which is pretty healthy. We have a really good setup for the economy. And this is all happening as we're going into a rate cutting cycle, which is unique. So the Fed is about to start turning from a foe as they hiked interest rates, tried to curb growth in their efforts to fight inflation. So they've been fighting the economy to some extent. And now they're actually turning into a friend, right? So this elusive soft landing that we've all heard about has been playing out. And I think that's the story. And I think that's what markets are cheering right now because the uncertainty is gone and we can focus back again on where we are in the economy and where we are in the rate cycle.
So it sounds like no matter who would have won, your expectation was that the market would have gone up regardless based on history and based on the current economic environment.
Yeah, I think that's right. I think that the composition of the different sectors in the market may have been different in terms of performance, but I generally think, again, the economic setup is really what overwhelms anything else. And I think the economic setup is good. And we're having that going into a rate cutting cycle, which, again, I think is just going to add more fuel, right, to the economy. So I think that's really what people are focused on.
Okay. And so given the election results, like we're discussing about the Fed's moves, how do you think that the Federal Reserve's monetary policy might evolve?
Yeah. So I think that's a really great question. And I think that's a really important question because the last several years, the theme of the markets have been inflation, monetary policy, what the Fed is going to do. And I think that's really been what has been driving markets. And I think for the most part, that's going to have a huge impact still on performance of financial markets. I think the punchline is I don't expect anything to change near term for the Fed with the result of the presidential election. I think maybe the starting point to talk about is whether or not the Fed actually remains independent, because there's been a lot of news and press about Donald Trump's comments on wanting to have influence on monetary policy. So Look, I think that we're going to have a very vocal president. I don't think that I'm going out on a limb in saying that. I think he's going to be very vocal about what he believes. I expect the Fed to remain independent. I think Jerome Powell, who is the chairman of the Fed, is steadfast in wanting to maintain independence from politics for the Federal Reserve. And I think that the markets would respond pretty negatively if we saw the president or politicians ultimately trying to interfere with the Fed. And I think Donald Trump also cares a lot about the markets, right? So I think that would be a negative signal. So I expect the Fed to remain independent. And so I think what they're going to care about really is the data. And that's how they're going to guide monetary policy. And then you go into what does the data say, right? The data says that inflation has come down a tremendous amount. So inflation is just not nearly as big of a problem as it was going back 2 years ago, right? And I think it's actually hard to overstate just how much progress we've made on inflation. The latest readings on inflation are somewhere in the 2.3 to 2.7% range, depending on the data point that you want to look at. And it wasn't that long ago where we were seeing CPI readings of 9%, right? And the last time we had inflation hit those levels, it took us a decade to get to where we are now, right? So we've gotten there like pretty quickly. And so inflation has come down a lot. And we're still in restrictive territory in terms of how high rates are. So I think the Fed has a lot of room to continue easing, continuing to modestly lower rates, and reach what they believe is a more neutral rate as opposed to a restrictive rate. So I think that continues to happen. I think the Fed is doing a victory lap to some extent right now. And you can hear it in Powell's comments. So you can hear him talk about how the wage market has cooled a lot, right? So wage gains are not 6+% anymore. Unemployment is still low, but it's moved up. It's back up above 4%. So the labor market is significantly less tight, and they felt like it was dangerously tight for a period of time. So it's significantly less tight now than it was before. And so it's just not that, it's not as big of a problem to try to cool it. The federal funds rate, like the rate that the Fed actually controls, that's still about 4.5%. And we're seeing inflation readings at 2.3%. That's like 6-month core PCE. Definitionally, that would mean that we're still in restrictive territory. We could still lower quite a bit and still be restrictive for the economy. I think the Fed is going to continue to do that. And they're even telling us, even if they see some blips, like the next couple of months, if we see a little bit of a hot inflation print, um, Powell basically told us that that's not going to necessarily change the near term course, right? They don't want to put us into a recession unnecessarily. So I actually think it's more likely that the Fed acts quicker than people think and lowers more aggressively in response to economic data points that come in weak than the risk of them not actually continuing to cut. I think if you look past maybe the middle of next year, when rates are 1% below where they are today, if we're closer to 3.5%, it probably becomes a little bit more of a question as to where do we go from there, because this last mile of inflation, which is trying to get back to 2%, may be harder than we think. So I think that's still a little bit unclear. But I think for the foreseeable future, we're going to be on this glide path of rates coming down. The Fed is telling us that's what they want to do. They're not trying to be our enemy. They're not trying to put us into a recession. As long as the data kind of continues to be generally supportive, there's a lot of room for them to bring rates down and still be restrictive, but less restrictive.
So if I'm thinking about rates, before we get into more long term, I'm thinking about, okay, so I have a mortgage, then I have an investment property as well. And I'm thinking about my rates. They're not exactly where I want to be. How far do you think we're going to see the Fed take rates, let's say in the next year?
Yeah, look, it's an interesting question because I think that one of the misperceptions out there is that the Fed controls your mortgage rates, and they actually don't, right? So the Fed controls very short term rates, which is called the Fed funds rate. That's the rate that banks lend to each other at. And that is important for a lot of things. It influences some variable rate loans that you might have, some credit card loans that you might have. It influences what corporations could borrow at. But your mortgage rate is actually not necessarily correlated or tied. It's not necessarily tied to what the Fed is doing. So that's much more tied towards longer term rates like the 10-year rate or the 30-year rate, which really is controlled by the financial markets and not necessarily the Fed. So I think it's an important distinction because the Fed could continue lowering rates, but you may not necessarily see that translate into the 10-year rate coming down, the 30-year rate coming down, or your mortgage rate coming down. That's actually exactly what happened last week. right? So we've seen the Fed bring rates down 50 basis points the first time they cut. Last week, they cut by another 25 basis points. Mortgage rates are actually higher than they were before. And so that's much more of a reflection of what people expect longer term inflation to be, what people expect longer term growth to be. And so if you are waiting for the Fed to move down in rates before you're pulling the trigger on a real estate investment, it's not quite that simple. We can talk about real estate in general as an investment, but I think, again, mortgage rates have much more to do with longer term inflation expectations, which are also moving higher. And that's an interesting result of the Trump election is that we've actually seen mortgage rates and longer term rates move a little bit higher. And that has to do with concerns around the deficit, which we can talk about.
Yeah, let's get into that. So, what about those longer term rates? What are some of the concerns on the deficit from some of Trump's policies?
So I think the knee jerk reaction for a lot of people is a lot of these policies that Trump has been proposing are inflationary, right? And I think that in a vacuum, that is true, right? So I think tariffs, which obviously he's been very vocal about, in a vacuum are inflationary. They potentially raise the prices of goods that we're paying for. And so that's inflationary. Lower immigration or supply of labor in a vacuum, that's inflationary, right? Tax cuts in a vacuum without anything to offset it is inflationary, right? More people have more money to spend, so they're spending more money. So I think that's part of the reason why we've seen longer term rates move a little bit higher since he got elected, because there are starting to be incremental thoughts or concerns about what is the inflation picture going to look like over time. I think one of the big things to remember is that the deficit, which is what people are worried about, if we have an increasing deficit, we are going to have to print more money, which again is inflationary. That is, I think, a lot less important than the ratio of the deficit to our GDP, right? It's like your debt to income ratio. And if these policies net out to higher growth and more GDP over time, they're not necessarily problematic, right? And I think that's actually part of the reason why the move in long term rates, the 10-year bond, for instance, was actually a lot less pronounced than a lot of people expected. I think a lot of people expected if Trump got elected, we would see a massive move above prior highs in long term rates. And we didn't necessarily see that. And I think part of it is because there's an expectation that growth is also going to accelerate. So you can support that higher rate outlook. I also think that to put it in perspective, on an absolute basis, like these longer term rates right now, they've moved up, but they're really not that high compared to history, right? So we're at 4.3-ish% on the 10-year yield. And that's still well below historical averages. Like in the early 2000s, we were around this level, actually a little bit higher. Prior to that, in the 90s, we were in the sixes. In the 80s, we were in the teens. 4 point something percent is much more normal than what we saw when we were closer to two or zero, especially post a pandemic. So this is okay. This is normal to some extent. And usually the 10-year yield is actually 1 point above where the Fed sets its rate, right? We are currently at 4 something percent and the Fed rate is still a little bit higher than that. So you would think that normally it wouldn't be crazy for the 10-year to be in the 6% range, but it's not. So I think part of the reason why it's not higher is because people also expect, especially with a red sweep and Republicans taking control of the Senate and the House, there's going to be less spending and there's going to be more cuts to government spending. So, with all these policies that also seem inflationary, I think the expectation is there's going to be some offsets to the inflationary pressures of lower taxes and tariffs. And I think it'll be easier to get those through given that we actually have Republicans controlling all aspects of the House and also the presidency. I think we are not necessarily sitting here overly concerned that the deficit is about to skyrocket. I think one of the things that we talk a lot about internally too is that we've lived in a very deflationary world for a long time, right? So we've had the last few years marked with very high inflation. But if you go back to the period prior to that, the 10 years prior to that, prior to COVID, we actually couldn't even get the PCE index to 2%. And part of what the Fed was trying to do was to stimulate and make sure that there was a healthy level of inflation in the world. in the US. And part of the reason for that is because technology has and productivity, right, has been lowering prices. And so one of the things that we talked about is, do we still believe that those forces are at work, right? Is technology and productivity gains still influencing generally the prices that we pay for things? And if you believe in the power of AI, which we certainly do, and you can see things like thousands of dollars of legal work being done for a few dollars based on AI in a matter of seconds. If you think about, even not to tout range necessarily, but if you think about our um, pricing structure, we have members that were paying 30, 40, 50, $60,000 for advice and for an advisor. And now they're paying 90% less than that, driven by the power of technology. And so if you believe that'll continue, then I think there's a lot of deflationary forces that exist. And so it's not a foregone conclusion that we're on this path of no return in terms of the deficit, right? So I think that we're moving in the right direction in inflation, and we've seen that over the last year or so. And then we'll see basically how things progress once these policies are actually enacted and all the offsets are better known.
All right. So speaking of tariffs, brought it up a little bit a few times now. How could the trade policy affect global markets? And then what should investors consider in the portfolio allocations based on the new tariff policy?
Yeah. So I think there's still a lot to be determined on what happens with tariffs. We've obviously seen really big numbers be proposed, numbers like 20% tariffs on all imports, 60% tariffs on China. And so I would say a couple of things to remember. So I guess first, we don't actually know where we're going to land on any of this stuff, right? There could be some element of negotiating tactics. It's still not clear exactly who Trump is going to have around him in the administration. I think again, he'll likely pay some attention to what markets tell him. And so it's not clear exactly where we're going to land on tariffs. The second thing I would say is that tariffs, especially right now, are not new. So we saw a Trump presidency and we saw a lot of tariffs implemented during that presidency. And what happened under the Biden administration is that he actually kept and increased a lot of the tariffs that President Trump had put in place. And so our starting point today is a lot different than it was in 2016, 2017, where companies in the US are already adjusting and have adjusted quite a bit to the new realities of global supply chain. That was also accelerated by COVID because there were so many issues in getting your supply chain actually into the US that a lot of these supply chains got moved closer to shore regardless of tariffs because you recognize what a risk a pandemic or something like that could pose on your business. So I think that we're in a different starting point. I think this is more of a continuation to some extent, but there's still a lot to be determined on tariffs and exactly where we land. You mentioned a little bit about how should we think about portfolio allocations because of that. I think we still believe that US stocks and bonds are one of the most attractive places to invest in the world. So the portfolios that we place our members in, they're 60, 70% weighted to US stocks and bonds. And that's because we think the United States economy is really good and it's attractive to relative to most places in the world. But we're huge believers in diversification. And I think with the potential for tariffs, with a lot of uncertainty as to how these policies actually get enacted, there's all the more reason to make sure that you have a diversified portfolio. And again, the US has been a fantastic place to invest. We think it'll continue to be a good place to invest over time. But if you go back in time, there's numerous periods where having exposure to other regions of the world was really important, right? And it was important to balance out the US exposure. And you actually had international stocks outperform US stocks in many periods, right? You go back to the early 2000s, it was emerging market stocks. You go back to the 80s, it was Japan. So I think we're believers in diversification. I think that it's important to not assume that because we have an America first policy and rhetoric, that means that other parts of the world can't also do well financially. One of the things that I think is interesting is in the first Trump presidency, with all that rhetoric and with all the nationalist um, type of agenda that we thought we would be promoted, if you look at the first 12 months of Trump's presidency in 2017, developed international stocks actually outperformed the S&P 500. Emerging market stocks actually outperformed the S&P 500, which I think would be surprising to a lot of people. Even recently, if you look at last week, I think the knee-jerk reaction is Trump won. This is going to be bad for China. The Chinese stock market was up last week. It's actually up almost 30% since September, right? And because there's a lot of other forces at play, it's not just China has other trading partners. It's not just the US. China also has its own version of stimulus going on right now, right? So having some exposure to other parts of the world, I think we're still very big believers in. And I think that all of these policies, including tariffs, don't change that view.
Okay. It's interesting to hear that about Trump's administration. You forget about that, but 2017 was a great year for emerging markets and foreign markets. So, how might investors think about preparing their own portfolios? Is there an action that as a range client you might want to consider here? Tell me how to navigate that.
Yeah, I think it's important to have a diversified portfolio. I think I talked a little bit about the geographic diversification. I think the other thing that we make sure to have in our members' portfolios is also diversification in terms of market caps, right? So the S&P 500, which again has been a phenomenal index, is the largest US companies. But there's a lot of smaller companies that are not captured in the S&P 500. And there's a lot of opportunities we believe beyond the S&P 500, especially if we kind of continue this train of thought around tariffs, right? Smaller companies are actually less exposed to global supply chains. So they would probably be less impacted negatively by adverse tariff than larger companies may. Smaller companies also typically pay a higher share of US corporate tax. And Trump has proposed lowering the US corporate tax, so they would be bigger beneficiaries on that front, right? Just looking at last week, the smaller and mid-cap companies, the IWM index outperformed the S&P after the Trump election. So it's important to have some exposure to US stocks outside of the S&P 500 as well. And we think that's really important to make sure that you have that diversification in your portfolio. And then if you look out the next couple of years, look, we could continue to see the dominance that we've seen from large cap tech continue. And we want to make sure that we have exposure to that. But if you look at consensus expectations for growth, as we start to price in a soft landing, the sell side consensus actually expects small and mid cap companies to grow significantly faster over the next couple of years than the S&P 500. So I think if that ends up playing out, you want to make sure that you have some exposure to that. So in the way that we construct portfolios, we emphasize diversification. We make sure that you have exposure again to some of the most attractive companies in the United States, but you're not leaving out some other parts of the market that could perform really well.
Well, let's talk about housing. I think there's a lot of people out there that they see this uncertainty and they wonder, are we at the bottom? Where are we at with the housing market? And they're potentially waiting or thinking about how they might strategize their next move. They would find the next investment property. How do you think investors should think about that?
Yeah. So I think housing prices have not really come down. Despite rates having moved up quite a bit, we haven't really seen housing prices come down. And that's mainly because there's not that much inventory, right? So there's just like a lack of supply in the housing market. And there's not a lot that we can do, really, unfortunately, to create supply. So both candidates had talking points as to what they would do to solve this crisis, the affordability crisis or the housing crisis. And again, there's not a ton that I think is impactful in terms of what policy can actually do. And I think part of it is people can't afford to move to some extent. So I have friends sometimes ask me, "Oh, should I wait necessarily to buy a house?" And the question is, what are you waiting for necessarily? Are you waiting for a meaningful correction? Like how is that going to come? It's not that if somebody loses their job, all of a sudden they're going to have to move out of their house because they're probably locked in at a very low interest rate that they got. So over 50% of mortgages are below 4%. You can't go replicate that. And so one of the cheapest places that you could probably live if you already have a mortgage is your own house. So there's not a ton of supply that's likely coming into the market. And prices, again, have not really come down. They may not go up that much anymore, but it's not clear what would force prices to come down meaningfully. Of course, a meaningful recession or some exogenous shock could always change that.
Let's talk about retirement portfolios. Obviously, as you grow your wealth, a lot of your wealth is going to be in those retirement portfolios. All right. And you also look at those maybe a little differently than you might look at your taxable brokerage accounts. So, how should people think about their retirement portfolio makeup?
Yeah. Look, I think it's important to get to where you need to be in terms of your allocations, aligning them with your long term strategies and your risk profile, right? I think one thing that you could take as a positive from recent market moves is if you need to rebalance, this could be a good time to do that. So if you've been at 100% equities, but based on your long term goals and based on your risk tolerance, you and your advisor determine that it actually makes more sense to be in a 90-10 portfolio or an 80-20 portfolio in terms of equity to fixed income. You could be rebalancing right now at a time where equity prices are at all-time highs and bond prices have just corrected a bit. So it's a better entry point than it was even a few weeks ago. So I think if it makes sense to rebalance, you should do that. And you should think much more about decades in terms of what you're expecting to do in the markets as opposed to timing the next specific market move. But you can take some comfort in knowing that this could be a decent time in terms of entry points to go ahead and make that rebalance. I think some of the other things that we would note is that there's a lot of people rushing to do Roth conversions because they expected the tax code to potentially change if Kamala Harris had won the presidency. And so it's unlikely that the tax code changes meaningfully, especially not in an upwards direction, given what we've seen with the election results. And so there's probably less of an urgency to do those Roth conversions. But of course, if it makes sense to do them, we would recommend that we do them. And so an advisor can certainly help you determine that. And then I think outside of that, there's a lot of details that are still to come. So there's a lot of tax proposals that are very different. Some of them seem really meaningful. We'll see what actually gets implemented, but there's proposals to, of course, lower the income tax rate, potentially even abolish the federal income tax rate. There's proposals to shield Social Security income from taxes, to change itemized deductions for things like state and local taxes, which have been capped for the last several years. And so all of these are going to impact your retirement plan. They're going to be impacting how much you should be putting aside for taxes. They're going to be impacting the types of investments that you would make. And so I think it's important to stay vigilant in terms of following what the details actually are as they unfold. And that's what we're doing for our members, right? So making sure that we have all those tax inputs and we're partnering with our members to have a real time reflection of what their tax planning strategy should be, what their retirement strategy should be, what their investment strategy should be.
Awesome. So one final question for you. So we talked about a lot of different topics today. What is the overall takeaway for a range client after the election?
The economy is in a good spot. Inflation has come down a lot. Rates should continue to come down near term. And we should take comfort in these things. We should celebrate these things. Work with a trusted advisor to develop an investment strategy that's consistent with your long term financial goals. Avoid trying to time the market. One of the most costly mistakes you can make is straying from your investment strategy due to market noise or at the wrong time. And an advisor can help you tune that out. Pay attention to tax and policy changes. There's quite a bit likely to come. And use us as a resource to help you navigate how that might impact you directly and keep you on track ultimately for financial success.